Hello everyone and welcome to a new ATFX report. My name is Gonzalo Canete and I'm here one more time, 1 week more, to give you a fresh update of the global market situations, and in this occasion about Federal Reserve, where we're going to discuss what was the impact and what we could expect the coming seasons on the market on the rate cuts done the last week, 50 basic points. Let me share the screen with you so I can give you more details, and please remember, as usual, if you are not subscribed to our channel, please click on the subscription button and also on the bell to receive notifications anytime we update a new comment, a new report on this regard. I would like to start saying to you the basic points that we're going to discuss during this video. Number one, $2.6 trillion on bank deposits waiting to be moved in different sectors and the market. So this is the first factor we need to analyze. By the end of the video, we're also going to analyze the impact on the markets, SP 500, gold, dollar index, and also euro dollar and cable to see exactly what is the impact that this interest rate cut is causing on the dollar value. Point number two, we're going to talk about the labor market and how exactly this policy, this movement from the Federal Reserve in monetary policy respect is affecting the labor market, because it's supposed to affect positively, but I want to give you a free predictions of what happens historically in previous moments in the history when the Federal Reserve cut 50 basic points. Point number three is the Fed balance sheet and also the relation or correlation between Federal Reserve balance sheet and the value of the dollar, and also the value of the market. That's why I want to analyze by the end of the video the impact on the chart, which is the SP 500 and the close correlation with the Federal Reserve balance sheet, and also the dollar index and dollar currency and the close correlation with the Federal Reserve balance sheet. Now, saying that, let's go point by point and discuss. In terms of the 2.6 trillion of dollars available in bond deposit since 2022, basically the interest rates, the high interest rate has been an attractive option for many investors and even banks to keep on hold the money, because they basically receive a good interest rate. But with the 50 basic points interest rate cuts, we assume that 2.6 trillion of dollars available, they're going to move to another assets looking for more attractive returns. And that's why the main question is if these 2.6 trillion of dollars are going to start to cause a new bullish market in different sectors, like, for example, goods sector or health sector in the United States, which is one that has been highly discounted in relation or in comparing with the technological sector. Strategic sectors, that's the main point I was just highlighting on the presentation, that you could actually consider and take a look on those sectors. Companies like Johnson & Johnson or Unilever in terms of goods Walmart will be interesting companies to analyze at this respect. Now, I also bring to you one very interesting tweet who was published by JR Capital, which it was showing to us a chronological relation between two moments in the history when the Federal Reserve cut 50 basic points on the interest rates. One of them was January in 2001. The second one is in 18th of September of 2007. Both of them was moments previous to a market crash. As you know, the crash produced by dot-coms, the companies were quoting in Wall Street, that dropped massively after 2001. We can see that the next year, the movement happens in the next 12 months after that interest rate cut was a drop. On the SP 500, the biggest equity index in the world, was dropping 39% after the interest rate cuts of 50 basic points in one single shot. In September 2007, we have seen something similar, because immediately after the next 12 months after that 50 basic points interest rate cuts, the market, the SP 500 again, was dropping 54% in the next 372 days, which is again a massive shock. And in both cases, it was an increase in unemployment rate, which is what you are in the screen right now. Data from Federal Reserve showing the unemployment rate rising sharply with every single time that the Federal Reserve cut the interest rate. Another interesting correlation is the SP 500 and the balance sheet of the Federal Reserve, which is one of the points I want to discuss with you, which is that drop we can see on the charts on the SP 500 on the equity market anytime the interest rates are getting cut by the Federal Reserve. And the relation between the labor market, which is the main variable followed by the Federal Reserve, and the interest rates is very clear. We got I was saying here, like a dangerous precedent, because we analyze that moment, historical moments, when anytime they cut the interest rate, that happens. Now, the reason behind why this could happen is because in theory, when they cut the interest rates, what they do is actually reduce the financial costs for most of the businesses, small and middle business companies and families in terms of mortgage. So it's supposed to be done to release pressure on the economy. Now, I believe that is happening. There is a correlation between 50 basic points in only one single shot on cuts from the Federal Reserve and these kind of recessions, because by the time they cut the interest rate 50 basic points, is because a recession is already coming. That's why the Federal Reserve is cutting the interest rate. So in other words, a recession is starting, they cut the interest rate 50 basic points. The next few months, we see the impact of the recession, and the effect of that interest rate cuts start to happen in the next following months to reduce the impact of that recession by reducing the cost of the money. And we mentioned already the examples, historical examples. We got also here the interest rate relation with unemployment rate to see how exactly it's happening that historically the charts are clear. Anytime they cut the interest rates, the unemployment rate start to rise. And again, I believe this correlation is caused because the manuals of economy are telling us the opposite. This correlation is caused because the recession is starting, and that's why Federal Reserve is cutting the interest rates. Simple like that. Still, we need to analyze if this time, in this occasion, the rule still will prevail and prove the point or not. The continued balance sheet reduction. It's very interesting to analyze also the amount of assets that the Federal Reserve is liquidating on the market, which is more or less let around $60,000 million, 60 billions monthly on expiration on bonds held by the Federal Reserve. Which means, in other words, that $60 billion are getting out of the market by expiration of the bonds that Federal Reserve has been buying for the last 2-3 years massively. And therefore, it means a reduction of the liquidity of the market, and obviously less supply of dollars in the market causes an increase of the value of that asset, which is the main dollar. Now it's time to analyze the charts. It's time to analyze the impact of these interest rate cuts on the market, the immediate impact, because it was a few days ago, just the current. So far, I want to highlight a few markets. First of all, we're going to talk about SP 500. We're going to talk about dollar index, gold, and euro dollar and cable, which is more or less the same pattern as you will see in a minute. Now, in terms of equity market, SP 500 on the screen, we can see that they are celebrating really well the interest rate cut decision. It was already breaking up those 5,700 points, but by the confirmation of the interest rate cuts down, they basically quote up. But as you can see, they are not crossing the barrier of 5,800 points. So it's in a kind of on-hold moment right now. NASDAQ 100 is not even passing 19,950 points. As you can see here, is making a kind of resistance and not crossing the 20,000 points barrier or resistance. And therefore, still, in the case of NASDAQ, is the perfect proof or evidence that the technological sector is not in his best moment right now. And it's also caused or explain why this redistribution of capital, the one we mentioned, 2.6 trillion on cash available in bank deposits, could go to another more strategic sectors like health or like goods consumed. Now, in terms of dollar index, you can see here how the dollar index has been moving in a kind of runs between 101 points and 100 points. There is a clear resistance on those levels. Very interesting analyze how the impact of the interest rate was causing volatility on the day of the interest rate cut decision, but still, after 24 hours after, and even by today, the index is more or less what it was before the interest rate cut decision. Therefore, I want to say, even when the Federal Reserve cut the interest rate 50 basic points, your dollar is resistant, is still surviving over 100 points value, which means that the reduction of the balance sheet of the Federal Reserve is the main reason that is feeding up and making stronger the dollar. Because, as I say, less supply of dollars means the dollar increase its value. In terms of gold, we can see that it's doing super well. By the way, this is the target we indicate you weeks ago with the first breakout of the level of $2,500. we say, okay, the projection of the movement is giving us a new top record on that area, which you can see in long term with this chart, which is the pivot point of 50% of the previous run goes here, and it's coming from these other historical runs on gold. As you can see, the symmetry is really clear and it's really nice, and that's why we believe gold is reacting in a certain way that, in other words, if the monetary policy of Federal Reserves reduce the interest rates, reduce the value of the deposits in dollars, let's move to gold. And finally, Euro-dollar and cable, the pattern, long-term pattern is the only one I want to show you because to me, in my eyes, it's so clear. You can see that since 2008, the pattern has been a bearish pattern, reducing the value of euro-dollar, and therefore dollar should, if this pattern continues, dollar should drop, euro-dollar should drop, and therefore dollar should get strong against the euro. And if you take a look on cable, it's exactly the same pattern. You can see very similar pattern on cable, and therefore it means like if by any reason dollar is getting strong again, it's going to pull back and follow since 2008 this pattern, 1, 2, 3, and for the fourth time moving back the cable, moving back the pound against the dollar. That's all. I hope you enjoyed this market report, this weekly review, and leave me in the comments any other question. Please thumb up if you like it and subscribe to our channel. Bye bye.